Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Josh Northrop of Whitman Asset Management, one of the UK's finest investors. So welcome, Josh.
Morning, Paul. Thanks for having me.
Yeah, well, the markets actually have been surprisingly strong this year, especially out in the States on the back of softer inflation expectations and AI mania. However, sort of interest rates are likely to stay higher for longer, and we do actually still have an inverted yield curve. So putting all that together, what's your sort of outlook for equities going forward?
Well, I mean, the UK is clearly struggling from an equity market perspective this year. I mean, most equity markets are actually up, double digit or close to this year. Obviously, the Nasdaq's up, a lot more than that. And here we are with the sort of FTSE at best flat, and AIM is down. Smaller companies index is down, so the UK is really underperformed, and I suppose the main reason for that is that our inflation data has been worse. Our inflation stayed higher for longer than a number of other sort of economies, which has meant that interest rates look like they've had to go up, perhaps further than markets would ideally like. So the backdrop for the UK has been pretty negative in relative terms, and I think if you add to that the sort of political instability that we've had, 4 chancellors and 3 prime ministers in less than 3 years, so that doesn't look great for investors. But on the flip side, economists, I don't know, probably 10 or 12 months ago, and the Bank of England were predicting a very long recession, possibly the longest recession that the country had had. And here we are. We've avoided a recession, so perhaps growth has been a little bit better than expected. The economy showing a little bit more resilience than expected. In terms of small caps, Paul, I mean, we're getting on 2 years of sort of total shunned by investors. I mean, we've had immense outflows from UK small caps over the last 20 months or so.
And on that, just on that, Josh, your company did a brilliant report, and I highlight to investors for people to download this from the web. It's a January fact sheet for the small cap report, etc. And it showed those fund management redemptions, particularly from the open-ended ones. Can you just talk through that, because it really has been a sea change out of the sector? Yeah,
it's been extraordinary. So I mean, in October 2021, which was sort of the peak of the market, the value of equities in UK small cap open-ended funds was 20 billion, and there's about 50 funds in the sector, and since then 2 billion has been redeemed, so that's 10% of the value of the funds at that point in time. So what that's done, of course, is it's pushed down the asset class because it's relatively illiquid compared to large caps, and so the small cap asset class is down 35 to 40% from the highs.
And that's redemptions. That's investor redemptions.
Yeah, it's been driven by redemptions. I mean, you've seen huge money come out of the asset class over the last 18 months, and of course, while that's pushed the asset class down and has made it difficult to perform in that period, I suppose the flip side of this is that now valuations of the asset class are very, very attractive, and the asset class is trading on sub 12 times forward earnings, which is attractive to kind of long-term averages of mid-teens and long-term earnings growth of mid-teens. So yes, it's been very difficult, but the opportunity presents itself. Valuations are now attractive. And if you look at what smart money is doing in the UK, you will see that there is quite a lot of interest from private equity and trade buyers. We calculated that the value of takeout of UK listed takeouts this year is just shy of 9 billion now, and the average premium pool is in excess of 40% to the market price. So that tells you how cheap the market is in places. I mean, some examples were DECRA, that was 44% premium, Network International 64% premium, Gresham House yesterday over 50% premium. So private equity can see that the market's very, very cheap in places. And in addition to that, you've got a lot of share buybacks, a lot of management teams that are sat with meaningful net cash positions are buying back a lot of stock. So The million-dollar question is, what is going to reverse equity flows back to positive? And when that happens, we would expect that to be a more sustained rally. And I think, what we need to demonstrate, what the Bank of England needs to demonstrate, is that inflation is coming down like it has in the US, and that the Bank of England is in control of inflation. I'm not going to try and be a hero and predict it, because it's very complicated, inflation, and lots of very smart people, much cleverer than me, have failed to get it right over a number of years. But I think our general view is that if you think about where inflation has come from in terms of food and energy particularly, it does look like inflation will now start to fall. And obviously this morning we had the first signs of that with a pretty sizable reduction from 8.7 to 7.9% month on month, driven by food and energy prices falling. So I think we need more of that fall, more evidence that inflation's falling, and then I think we are well set for a much better time in the small cap market.
Yeah. And I'm guessing that's a sort of like it's a cost of capital story in terms of that small caps. If inflation does start to roll over, that'll allow people to bake in interest rate cuts by the Bank of England, which will then reduce the cost of capital, which then have more risk taking and flowing into small caps. And if you think that the market operates 6 to 9 months ahead of the economics, if we start seeing inflation rolling over sort of like, early next year, like back end of this year, then interest rates should fall similarly, sort of like perhaps back end of next year. And therefore, I don't know, Q1 next year would be a good guess, maybe.
Well, I've always I try not to guess exactly when it's going to happen, but I think, you've got to say at the moment that, inflation looks like it's coming down, valuations are cheap. So, without trying to call the bottom, I would say that now's a pretty good time to be investing in small caps. And historically, when you've had these big bear markets, and small caps always fall more than large caps, that happens pretty much everywhere. When you do get a rally and you do get the next bull market, the initial 6 months, you can make, very attractive returns. So it's worth being invested, to benefit from that when it does come, instead of perhaps waiting, until everything's rosy again, because by that point the market will be much higher.
Yeah, no, I would agree. It's better to be earlier than too late, no doubt about it. And given that sort of backdrop, if we've got this sort of like, window of sort of maybe 6 months or so to keep sifting through some babies in the bathwater, what type of characteristics do you and the Whitman Fund look for in sort of like, good quality businesses that are worth backing for the long term?
Yeah, so we are sort of small cap investors. And we invest across the small cap spectrum, and we're really looking to invest in leading growth businesses in their respective industries. We like profitable businesses that are very resilient, so they've got high margins and high levels of kind of non-discretionary revenue or recurring revenue in structural growth markets. So these companies have the ability to grow their earnings and cash flows, but are market leaders in their industry, so have a degree of protection from a margin perspective. We like backing very experienced management teams, so we often invest alongside family-run companies or founder-led businesses. We've got about 30% technology, which is mainly software exposure. We have very little consumer or retail. We don't invest in commodities, binary outcome companies, deep value situations. We're really focused on investing in the best quality compound growth stocks at sensible valuations. So those are the types of things that we're looking for.
Okay, so let's move on to some of those with the sort of software and long-term compounders, which have done well, which I think there's a bit of a star in your portfolio, is Tracsis, which is a sort of like a category killer in all things software, rail, transport and rail, particularly in the UK, but has now got a beachhead, having done an acquisition out in the States. Just sort of latest view on this one, because there's no doubt about it is a top quality firm.
Yeah, so Tracsis is a niche sort of technology company that services the transportation industry with a market leading position in the UK rail market, the UK rail software market particularly. So they have a variety of hardware and software solutions that help rail operations run smoothly, which I know sounds ironic because most people hate.
Just going to say, get them going on time. Is it punctuality?
Exactly.
They need a lot of help.
Yeah, they have things like rail planning and performance software, timetabling software, digital ticketing solutions for customers. And they actually spun out of Leeds University 2004, I think, and have since grown organically, kind of mid-teens, mid to high teens organic growth. And they've alongside the organic growth, they've pursued a very successful kind of bolt-on M&A strategy, and they've probably made about 15 or 16 acquisitions in the last 14 years. But importantly, Paul, all the growth has been self-financed. They never come back to the market to raise money, which as investors we really like because it's non-dilutive, and it shows that a business is actually funding its M&A out of cash generation, which we really like. So yeah, I mean the story with this is just much more of the same, really. Continuing to grow organically. The rail industry, there's lots of opportunities for them to digitalize, become more efficient, particularly with some of the environmental regulations that are coming in. And as you said, North America, they don't put anything in their forecasts for big contract wins in North America. So there's optionality from that perspective if they do deliver on that. And they have won a few contracts in North America, which is exciting. They've got about 17 million of net cash, so they're well financed to keep doing acquisitions. And the thing we like about Tracsis is that, if you look at the accounting, it's very conservative. So in terms of capitalization of R&D, it's very, very low. So they expense most of their technology spend. So if you look at the earnings, it's a very clean profit metric. So although the multiple is sort of low 20s, with a history of growing, earnings and cash flows, well into the high teens, we think that's relatively attractive for a market leading company.
Yeah, no, I would agree. And given it's, it looks like a jewel in the crown, and it's one of those where the M&A boys, I'm sure, have been putting the slider all over, that's for sure, because it's pretty unique trophy asset. Now, moving on to another company in the tech space, IQGeo, which came out with a very positive trading update a couple of days ago. Frankly, it's knocking the ball out the park. It does sort of like geospatial productivity, asset management type software for I think for the telco space and hyperscalers and data centers. Do you take us through this one? Because it really has been a terrific performer of late.
Yeah, it's been a really good performer the last 12 months. One of the few companies that's been a really good performer over the last 12 months. Yeah, so they're a company that provides geospatial software to the telecommunications and utility markets to basically help them build, manage and operate their networks of assets. And they've got a large client bank, about over 400 clients, and there are about 80,000 people using their software. A lot of them are field engineers. So, if you call out an engineer from AT&T or something, they may well be using IQGeo software to identify where certain assets are within their network. So, the core drivers for this business are things like fiber to the home, Internet of Things, 5G rollout, effectively, enabling these utility and telco companies to have more knowledge about where their assets are underground in a digital format that's easy for field engineers to use. And their core USP is really around usability. So a lot of field engineers would speak very highly of IQGeo software because it's very easy to train someone on it, and therefore it's very popular amongst people that use it. So yeah, they have a very attractive business model. They sell their software on a sort of per seat per module subscription basis, and it's very sticky. Once you've got a big utility company to migrate to IQGeo software, it's pretty hard to displace. So there's very sticky revenues, and kind of net revenue retention is consistently above 100%. I think they just reported above 115% on Monday. So that's telling you that your existing clients are growing 15% organically with you anyway. So you know, that's before you've even gone and won new clients. So yeah, I mean, it's very interesting. It's been on a contract win run with lots of you know, some of them they've announced, some of them they haven't, but you know, big US and German fiber operators turning to IQGeo. So it's super interesting company. You know, is now profitable, growing revenues, you know, at a very high rate. Multiple is high, but you know, the growth rate is extremely high.
Yeah, I mean, to win that many contracts overseas with large blue chip clients, being a sort of UK, you know, sort of provider, it just says everything that does, because typically they would go to your bigger players if there were anybody who had better solutions, but they clearly haven't. So yeah, certainly a terrific stock and has done well. Another one in the same area is Calnex, which does sort of like testing instrumentation and solutions, I think, again, for the sort of 5G network, hyperscalers, data centers, etc. Can you take us through what these guys actually do in terms of sort of like what their solution is? Is it, yeah, go on.
So, I mean, they have leading software and hardware that enables kind of synchronization and performance validation of telco and high-speed data networks. So, and their software is, you know, their equipment is sold to clients like Verizon, Facebook, Vodafone at the point of developing, you know, the data network or the piece of equipment that they're dropping into the telco network. So it's effectively testing equipment to ensure that everything is synced.
Yeah, okay.
And as you know, so yeah, I mean, that's what they do. It's been around for a while and is run by the founder, a chap called Tommy Cook, who's actually a sort of an expert in this field. He still owns 20% of the company. So yeah, I mean, the implementation of the 5G network, along with, you know, things like the Internet of Things, the kind of AI driving complexity within data centers, all these things.
That'll be huge, won't it? With all the GPUs being put in, the requirements for speed, both in data centers and at the edge of the network, you're going to have huge load and capacity demand.
Exactly. And so Calnex help drive efficiencies within the network. So you know, someone like Facebook uses them to just improve you know, the configuration of their data center network just by, you know, absolute tiny margins, which saves them vast sums of money and can deliver a better service. So again, the market backdrop is very, very positive for this company. It's got a phenomenal client list. And actually for a hardware, I mean, it's hardware and software, but, you know, for a hardware business, you know, the margins are very high. I mean, you know, gross margins in excess of 75%. So there's clearly a lot of value add here. They did go into some weakness in the telco market earlier this year, which coincides with the likes of what Spirent have been saying and a couple of other players in that market. So the shares did have a bit of a wobble, but fundamentally, we actually think that's probably a really attractive entry point. You know, this is a market-leading company in a high growth market with tier one customers. So if you believe in AI and data centers and 5G and all of these big tech trends, then you know, this is an interesting one to look at.
Yeah, I mean, that, and also, again, another sort of trophy asset in that whole space. I mean, Spirent might well be interested because they do testing. I know it's mainly of handsets, but similar sort of thing. And I mean, the big equipment manufacturers, the OEMs, Ericsson, Nokia, Siemens, these kind of guys might be running the slider all over it as well. If you've got unique technology, I mean, 75% gross margins is fabulous in that area because it's pretty damn competitive. Now, moving on to more software, IDOX, which does sort of document management and productivity software for the public sector largely. Do you take us through this one? Because again, it's well priced, but you know, deservedly so on, you know, given the quality of the business.
Yeah, so I suppose we've just discussed a couple of high growth businesses, and now we're going to discuss, you know, a lower growth business. The IDOX is an established company. It's been around for 30 years, and they sell software to local councils to help them with things like property development applications, you know, healthcare records, transportation information. And really their solutions are designed to help councils with productivity and help them, address pressure on budgets. So that's what they do. And I think, because they sell to the councils and their software gets totally ingrained within a council's processes, it's incredibly sticky. The revenues are really very, very sticky. It's very hard to displace them, and they've got a market. They've got a very strong position in their market. There are a few other players in their space. IDOX is certainly one of the biggest. The growth is sort of mid to high single digits, organically. In some years they will do slightly better than that, and other years they may do slightly worse than that. So it's not a high growth business, but you're talking about a company that's got really high EBITDA margins, in the mid 30s and sort of 100% cash conversion. And I think what's made us particularly interested in IDOX more recently is that, I suppose, about 5 or 6 years ago, the company made a couple of acquisitions under a different management team and leveraged up the balance sheet, and it all slightly went pear-shaped. And the new management team have come in and have spent time just straightening the business out and selling some non-core assets, deleveraging the balance sheet and getting them back on the front foot. And the company is now in a much better position. They've actually got net cash for the first time in a long time. They're growing organically. They've been investing in kind of some product innovation to help cross-sell to various councils. And so, I mean, if you believe that councils are looking to drive efficiencies and digitalization longer term,
hope so.
then IDOX is an interesting play. I mean, and this is a company that will do, I don't know, 24, 25 million of EBITDA with very high recurring revenue and now net cash. So, they will look at M&A again, and that's not baked into forecasts. So we expect M&A to supplement, high single digit to maybe low double digit organic growth, and that provides quite a powerful earnings story.
Yeah, have they gone through the SaaS transition fully? Do you know?
Yeah, a lot of their clients have. That's been one of the things they've been doing.
Yeah, okay.
Which is, and there's a sort of upsell opportunity with that transition. So yeah, I mean, it's not the most exciting company in our portfolio, but it's probably one where we see some of the least earnings risk.
Yeah, no, I mean, I would agree with sticky revenue streams in an area that the government has definitely got to be improved productivity. In fact, everywhere has, but certainly in that respect. Now, again, moving on to another one, which is SDI Group, which is a bit of a mini Judges Scientific, I think, in terms of specialist instrumentation for the healthcare sector and science and R&D and all this sort of stuff. I'm guessing it probably got a bit sort of like impacted by the end of COVID, because it used to sort of sell into the PCR instrumentation business, I think, or that industry.
Yeah. I mean, I think that's exactly right. It's got similar characteristics to Judges Scientific. It's a collection of specialist manufacturing and design companies for the sort of life sciences and imaging industries. They've got very niche pieces of technology. So, it has similar characteristics to Judges from that perspective. It tends not to be too cyclical because it sells into very specialty industries that tend to be sort of, growing industries, not too tied to GDP. So, our view is that it's not too tied to the economy. That said, they did reference some weakness through a couple of their divisions that experienced a lot of demand through COVID. As you said, they were selling cameras for COVID testing in Asia. The story with SDI is really one about backing management team. Mike, who's been running the company for a number of years, has a phenomenal track record of buying businesses out of self-financed cash flow, and getting those businesses to grow slightly faster than they previously were. The sort of 6-year earnings CAGR of the group is 25%, so extremely high growth business. But a lot of that's come through M&A, and he's got a real skill in identifying businesses at a sensible price and dropping them to SDI, much like the chaps at Judges Scientific did as well. So it's one of those businesses where the multiple probably looks possibly a little bit high, but he will do more M&A, and the organic growth is kind of consistently mid to high single digit. I think that's what they're targeting. More recently, it's been quite volatile because of COVID, but effectively you're getting mid to high single digit organic growth with self-financed M&A from someone who, you know, knows what they're doing.
Yeah. And I think also, if we're right in terms of, we see a change in sort of sentiment and economics towards the back end of this year, plus probably a lot of management teams, particularly at quality companies, are sort of being ultra cautious with their expectations and guidance, then with these businesses which which are well primed in secular growth trends, then there's a strong chance maybe next year that some of them beat their expectations. Under promise and over deliver is always the game with these top quality companies. Now, staying in the healthcare sector, Ergomed, which is basically a contract research manufacturer, organization, does sort of like, phase trials, etc., for patient testing, but also does testing of patients after the actual drug has been released for, say, side effects. Do you want to take us through this one? Because it's a really terrific business and a bit of a UK champion, really.
Yeah, so we see Ergomed as a sort of profitable, high growth company that gives investors relatively low risk to the drug development market. Is run by its founder, who still has a substantial stake in the company, and services over 300 clients in the CRO and pharmacovigilance market. So, it's a very high quality, well established business. In terms of the kind of market drivers, I mean, their CRO division which is sort of helping drug companies bring drugs to market and help them with their trials, is focused on oncology and rare disease, which is a higher growth part of the market. I mean, forecasts are closer to 10% per annum. And that division is sort of supplemented by a more defensive prime vigilance division, which is sort of growing about 10 to 15% per annum. So, we think that the business is, well set to grow with industry trends, but is exposed to the slightly higher growth part of the market. They have had a very good track record of doing M&A. They've got 20 million of net cash, and they've got 80 million of unutilized debt facilities. They've potentially got 100 million of firepower. And the prime vigilance market that they operate in, which is basically helping monitor drug side effects after drugs have been released to the market, which is a service that pharma companies are increasingly outsourcing because it's not core to what they do, but it's increasingly required under regulations. That industry, which is where Ergomed have a very strong position, is highly fragmented. So they've got this £100 million war chest and have a decent position in a fragmented market. The shares have performed poorly over the last 12 months. And I think one of the issues, as we discussed, the outflows, it's more liquid than many other stocks, so fund managers have probably been selling it to meet redemptions. It trades on about a 35% premium now to some of the US peers. It's on about 20 times, dropping to 18 times. And that's assuming no M&A. So they've got a lot of firepower to do acquisition. I think it's a stock that, when sentiment improves for UK equities, is well positioned, and it's got a great position in a growth market with a great management team. Yeah,
and we've talked about 6 companies so far, all absolute terrific businesses, no doubt about it, and they all potentially could be M&A targets, because when you get that level of quality, people always put them on their watch list. The corporates do, and the private equity guys. So if the price is right, then they come on down. Now, another one which falls into that bill is Advanced Medical Solutions, which does sort of all things sort of wound care and surgical dressings and medical grade materials, etc. And it's again got a top balance sheet, and high margins, EBIT 23%, etc. I mean, what's not to like, I guess, about this one?
Well, it's got lots of strong characteristics, and for many years was sort of a darling of the AIM market. I think a lot of people made a lot of money in it. Yeah, as you said, they're specialists in wound care. Their core product is called Liquid Band, and you know, it helps with you know, it's a skin adhesive for wound closure. And they've got a leading position in Western Europe, taking market share from some of the bigger boys based on slightly cheaper pricing and better product. I think what's not to like is that, you know, COVID massively reduced the number of elective procedures, and so growth slowed over COVID, and then since then, perhaps growth hasn't come back quite as people were anticipating. And one of the explanations for that is that the US market has become, you know, basically more competitive, as a number of competitors have been bundling up products for distribution. So that's kind of forced AMS to rethink their distribution capabilities in the US, which they are now doing. They're switching distributors. But yeah, our basic view is that this is a very, very high quality company. As you said, very strong balance sheet, 80 million of net cash, market leading positions. I mean, at some point they will do something with the cash. They haven't done something for a long time, but you know, it's good optionality to have that on the balance sheet, particularly, you know, in current environment. So I think, you know, it's a great business. That's you know, just there are a couple of things in the background that have made things a little bit uncomfortable the last 2.5, 3 years. But we're pretty confident that, you know, the growth will return, and you know, they've got a phenomenal set of products. So yeah, it's a great business.
Well, there must be synergies with people like Smith and Nephew. I know need to sort of like bulking up that sort of area, and lots of other businesses in the wound care. I mean, you know, look, all of it is sort of like, you know, 2, 3, 500 million type market cap or billion market cap. So it's good size for you know, sensible deals. Now moving on to the consumer, and obviously, you know, everybody be heading down the pub for the Rugby World Cup, having hit Wimbledon on over in SW19. Now Young's company does sort of pubs and is a brewery and hotels in the southeast. What's your sort of like take on this one? Because again, I mean the consumers are packing into pubs.
Yeah, it's one of our only consumer exposures. Investors often ask, what's the oldest company in your portfolio? And the answer is Young's, Paul. It started in 1831, which makes it, you know...
it's quite ironic, really, isn't the oldest and the youngest?
Look, I mean, the story with Young's is that it's a pub business that you know, manages a freehold estate of pubs in the southwest and in and around London. And the key difference with Young's from a I suppose experience perspective is that they only buy very high quality sites, and they invest a lot of money in those sites. You know, if you look at their capex bill annually, it's very high. So they keep their sites really top notch, which means the food is good, the beers are you know, there's a good selection of beers, and the hotel, you know, if they have hotel rooms, the rooms are nice and really competitive. And you know, the next kind of consequence of this is that over time they've been able to buck many of the trends within the pub industry and have delivered really attractive long-term like-for-likes. You know, they just announced, I think, above 6% in the 3 months to end March. So it's a really good, well-managed portfolio of freehold pubs. The freehold estate is valued at 800 million. And the market cap is 720 million. But the freehold estate at 800 million assumes that you actually sell all the assets and effectively wind it up, and in which case you'd have to pay the deferred tax on those assets. If you didn't pay the deferred tax, you just say, well, you know, what's the portfolio value worth without the deferred tax, i.e. keeping it as a collection of pubs, then yeah, the share price is more like £14. Versus where are we today? I think
12 quid.
12 quid. So we think there's, you know, decent downside protection from the property, and it's very conservatively financed. You know, lowest gearing in the pub sector. You know, LTV at 20%. So they can continue to acquire sites. It's the least geared pub operator in the market. So it's unusual for us because it's kind of a hybrid of consumer and property, but it's just unbelievably well run. If you look at the share price over many, many years, it's been a consistent performer. It's probably not going to blow the lights out. If you're looking for something that's, you know, going to go up 100% in a year, then this is not for you. But this is a very high quality, well-run business that will just deliver, you know, attractive growth over the long term.
Yeah, and it must be good to go and do some due diligence on that site as well beforehand. Now, another one in the sort of like the consumer sector is Yougov, but obviously it's an iconic brand. In fact, really one of the sort of the world leading brands, particularly as we come into general elections in terms of polling for the UK and for the US presidential. It'll be all over the financial press next year. It just bought actually a big business out in Germany for about 300 million euros, GFK, I think it was. Do you want to take us through your latest view on this one? Run by a real founder, CEO, Stephen Shakespeare.
Yeah, so I mean, speaking of visible brand, I think I read this morning that according to Yougov research, Rishi Sunak, 65% of people don't like Rishi Sunak. So the brand is everywhere, as you say.
Yeah.
Yes, I mean, Yougov is a long-term winner on AIM, one of the darlings of AIM, and it is a custom research and data analytics business. And I think their core USP is that they can provide kind of real-time opinion and very granular data on trends, on brands, so that they can assess, you know, how kind of consumers are reacting to certain things that they might be doing.
Yeah.
And you know, the custom research market is, you know, many billions of dollars. So little old Yougov is a tiny drop in the ocean and has been taking market share, you know, pretty relentlessly for you know, the last 10 years. They've invested a lot of money in their panel. So the core kind of thing that Yougov is, they have a panel of people that are effectively responding to surveys, and that enables them to aggregate, you know, the data and then sell it on to their clients. They've invested vast sums of money in their panel. And the one thing that we would just guide to is that historically the company have capitalized quite a lot of cost in terms of how they acquire those people. And so, you know, the profitability of the company is best assessed by looking at the cash flow metrics, you know, after their kind of investment in panel. But yeah, so the acquisition is interesting. I mean, they bought GFK's consumer panel business for 300 million euros, or 315 million euros. And I mean, the sale of that actually was kind of opportunistic because it came out of with the EU Competition Commission forced GFK to sell it following their merger with Nielsen, which has meant that Yougov have got hold of, you know, quite an attractive asset for only 10 times historic EBITDA. So I think our view is that yeah, it's a very, very good company. Historically, it's always had net cash, and I think with this deal, they're going to have a bit of, you know, they're going to be 2 times geared, falling quite quickly. But I think what it will force them to do is generate cash and perhaps just hold off the investment in their own panel, you know, a little bit, so that they do generate, you know, substantial amounts of cash to pay down the debt. So yeah, I mean, it's a growing company in a very big market with a very tenacious and innovative management team.
Yeah. How will generative AI play into it? Because obviously it's getting all its unique proprietary data from consumers. I'm just wondering how, you know, in terms of, is that that gives it an asset in terms of the AI leveraging, given it's got that insight, or its potential could be replaced by AI sort of like polling or disintermediating their service?
It's a very good question. I think AI is probably a threat and an opportunity for a lot of companies.
Yeah.
And I think it's just the market gets very overexcited, both on the negatives and the positives. And I think it's just too early to tell exactly how a lot of these things will happen and play out. But, you know, look, I think, you know, for someone like Yougov, AI has got to be an opportunity for them. Yeah. You know, whether they can automate some of their analysis more easily. So yeah, I mean, I don't see it as being a huge threat at the moment.
No, if you've got your priority, your own personal data, then that should give you something to leverage, no doubt about it. And another one which is maybe sort of like got some question marks with generative AI is RSW, which does all things sort of language translation.
RWS.
Yeah, that's right. Yeah, yeah, RWS. Yeah, sorry.
That's all right.
Yeah, it does sort of all things language translation for patents and for sort of like, it was the old SDI business as well for sort of websites and stuff like that. And the shares have really been hammered and trade on about 11 times PE at the moment, which is historically really cheap.
Yeah, well, exactly. I mean, we've actually got the P on about 9.5 times.
Okay, sorry.
But yeah, so I mean, look, 9.5, 11. It's a very cheap stock.
Yeah.
I think, yeah. So I mean, historically, again, this was sort of another AIM darling that did very well for a number of years. You know, provides sort of patent translation services to a variety of different industries. And I think the turning point was really when they bought SDL, which was another listed business in the space. And then since then, there's been a series of issues. You know, they've decided to increase investment, so margins have been pushed down in the short term. They've had some revenue, sort of weakness. There was a failed PE cash offer, management changes, and you know, all these things threw up an opportunity, we think, to get investors. So we've recently been, you know, investing in RWS because fundamentally we think it is a market leader in its market, and you know, some of the threats around AI and what that might do for patent translation, you know, we think are overblown. In actual fact, RWS, you know, use a lot of technology already in enabling their services. So they recently initiated a £50 million buyback, which is pretty, you know, we think that's pretty encouraging. And management have said that, you know, well over 50% of their translation is already, you know, using machine learning to a certain extent. So, you know, on 9, 10 times PE for a business that is, you know, market leading in a growth market, you know, it's not high growth, it's probably mid-single digit, you know, through the cycle, but massively fragmented. And this business, RWS, has been consolidating the industry over a number of years, very successfully. We think it's just the wrong price. I think it would be an attractive private equity takeout. At these levels. But you know, investing in stocks when sentiment's very poor is quite challenging. You know, you have to be quite thick-skinned. So you know, again, I'm not saying it's hit the bottom. You know, there could be another profit warning to come. But fundamentally, the share price is, we think, very attractively, you know, valued at these levels for a very high quality business.
Yeah, no, I mean, it's had a great track record. Well, it's certainly it's a category killer into patent translation. So yeah, for a private equity play, then it would make perfect sense. Another one which has been a sort of like a buy and build in the gaming sector has been Keyword Studios, which incredibly is now a 1.5 billion euro business. And similarly, it's had sort of like question marks over that sort of disintermediation of regenerative AI. It doesn't trade at quite as low a valuation, but it's still only 16 times PE with a good lot of cash on the balance sheet. What's your sort of like your view here? Because it's been a brilliant stock over the last 10 years.
Well, I think probably most people know what they do, but for those that don't, you know, it's a sort of outsourced technical and creative solutions provided to the gaming industry. So it helps gaming companies bring games to market, whether that be helping them with their marketing or their player support or their game development, have a range of different services. So effectively, you know, it's a picks and shovel play on the gaming industry. That's what we look at it. You know, they're not exposed to any single game like some of the game developers are, many of which, by the way, have all blown up recently. And so Keywords is kind of a play on the industry. And the key questions to ask is, well, is the gaming industry going to grow over the next 5-10 years? And we think the answer is yes. And the second question is, well, do you think, you know, developers will lean on the likes of Keywords more to outsource more of the more of the work to get a game to market? And we think the answer to that is also yes. So, the long-term structural growth is favorable. It's a very big market, $12 billion market, which is I'm talking about the outsourced service provider market, $12 billion. And Keywords have got 5% market share, but are 3 times the size of the second biggest. So massively fragmented, lots of room to grow organically and through acquisitions, but sentiment very poor. I think 2 things have really caused issues with Keywords. One is all the game developers have blown up. And I think, the problem with the game developers is that in COVID, there was this huge rush of demand for video games as everyone was locked up, which meant that supply increased drastically. I mean, huge numbers of games came to the market. And while the industry was growing in terms of total money spent on games, because the number of games being released was increased, much more than that, the kind of average revenue per game has been falling because there's too much choice. I mean, there's too much supply. If you're a gamer now, you literally can choose from thousands of games. So it's quite hard for developers to make money. And so, the developers have been having real issues. And that doesn't help sentiment for Keywords. And I think, you might see a little bit of weakness in their revenues. I think that's why the markets, the shares have come off quite a lot, because the market's probably predicting a degree of weakness at the top line. But fundamentally, you're playing the growth of the industry. And while this year the industry might, go, I think they're predicting the gaming industry might shrink 2 or 3% this year, off the back of exponential growth the previous 3 years. I mean, we think it'll get back to its long-term trend of kind of mid-single-digit growth longer term. So that's been one concern. The other concern has been AI. Again, we think it's totally overblown. And the market's just sort of panicking with AI in certain areas and saying, oh God, it's going to destroy this industry or destroy this company's margins. And I just think, this is a company that services, 24 out of 25 of the top gaming companies in the world, and has grown its earnings at sort of 30% per annum for the last 5 years. I just don't see it, being completely bowled over by AI in the next 12 months.
Yeah, no, I mean, with a, over 800 million euro top line, then it's a substantial business generating real profits and real cash. So yeah, I'm with you. Now, an sector which certainly won't be hit by AI, in fact, it could be a beneficiary, is sort of like pets, which is CVS Group, which does sort of like veterinary services and pet crematoria and online retail, etc. Sort of like a specialist roll-up of small veterinary practices, and it's trading at a sort of 20 times PE multiple. Again, a real high quality business that people don't tend to scrimp on their pets, do they? That they love.
Well, that's one of the things we like about it, is that again, it's been around for a long time. It's the second largest veterinary business in the UK. It's got about 9% market share, but it's resilient. You don't tend to compromise your pet's health if you're feeling it slightly under the cosh financially. And it's got a track record of delivering like-for-like sales growth. I mean, I think even in the financial crisis, it was pretty much flat, from a revenue growth perspective, which is pretty remarkable. The story has slightly changed. I mean, historically, it was really about, consolidation and bolt-on acquisitions. But then I think it was 2021, CMA got involved and actually, put their foot down on an acquisition and said, you can't acquire this business. And I think it was going to take their market share to more than 30% in a certain geography. And that's kind of where the CMA sort of say, actually, we feel uncomfortable with that. So, since then, management have focused more on the organic growth. I mean, they still are making acquisitions, but it's become organic growth first and acquisitions kind of on top. And so what they've been doing is they've been, opening new sites organically, and they have been investing in their existing estates and making sure that they have, the best equipment to be able to deliver, high margin procedures. The business model is kind of integrated in that it provides a lot of different services for pets. So they've got their own drug brands, they've got specialist referral capabilities, diagnostic capabilities, crematoria capabilities, and so they really can do most things. And the idea is that a number of their sites sort of maybe offer 2 or 3 of these services, and the management team are really focused on getting all their sites offering all their services, and that's driving this organic growth. And so it's probably not the sort of business that's going to completely shoot the lights out. But if you're looking for, you know, resilient business, very well run, market leading position, then, you know, I think CVS is a great option. And if you look at the private equity takeouts, you know, or multiples in this sector, they are meaningfully higher than where CVS is trading, despite the fact CVS trades on a 20 times earnings multiple, because of the attractions of the industry.
Yeah, no, you get lots of pricing power, don't you? No doubt about it. And particularly when you've got sort of like owners who have a sick pet, then it's got like accident and emergency. You've got to treat it, no doubt about it. Now moving to again other sectors that aren't being hit by AI, Ashtead Technologies, which is really another picks and shovels play on offshore wind and offshore sort of like oil and gas exploration. It does sort of like submersibles, I think, out in the North Sea, particularly is based out in Scotland, in Aberdeen. Do you want to take us through this one? Because again, I think it came onto it was listed a couple of years ago, but it's knocked the ball out of the park.
Yeah, I was going to say, I think it's probably the best performing IPO from that IPO mania.
Yeah, well selected.
Well, actually, I wish they all went that well. Yeah, so as you said, it's based in Scotland, and it's a global business. It's a rental business in the subsea rental market for offshore renewable energy and offshore oil and gas. Yeah. Selling, you know, renting equipment for things like inspection and maintenance, you know, underwater, quite complicated stuff. Their equipment does things like dredging, cabling, borehole inspection, you know, these types of things. And they've got about 19,000 bits of equipment, so lots and lots of equipment. So yeah, as you said, it's a picks and shovel play on the energy market, and principally, you know, the energy transition market. So about 30% of the revenues are around renewable energy, so offshore wind, helping get these wind farms up, and 70% is to the oil and gas industry, but about half of that is in decommissioning oil and gas rigs. So you could say that 50% of the business is kind of exposed to the energy transition market. The customers, you know, tier one customers, including, you know, likes of McDermott, etc. And one of the things that's quite interesting about the sector, and we're not heavily invested in oil and gas at all, very cyclical, hard to predict what's going to happen to the price of oil. But, you know, if you look at what happened between 2015 and Russia's invasion of Ukraine, I mean, the price of oil was, for that period, was consistently well below $80 a barrel.
It was minus 32 at one stage.
Yeah, and so a lot of these you know, offshore companies effectively were underinvesting in equipment, and now you've got, you know, a better oil price, albeit it's still off from the highs, but you've got massive need to reshore energy capability for obvious reasons with the war in Ukraine and sanctions on Russian, you know, energy. So all of a sudden, these you know, offshore oil and gas you know, companies are looking to ramp up production, and we think that's kind of a medium-term trend. I mean, it can't happen overnight, and they haven't necessarily got all the equipment that they need to do that. So the consequences that Ashtead Tech are really benefiting from this, both offshore energy, renewable energy in terms of new wind farms, but also this reshoring of energy, and they've got you know, they've got the equipment to be able, on a global basis, to be able to rent that out to their clients. There's an M&A story as well. For the industry, sort of rental market is very fragmented. I think they've got about 5% market share. And the biggest competitor is actually, you know, companies having the equipment themselves. But there is a trend to rent, you know, more of this equipment. It's not really core to these companies in terms of their CapEx programs. They should focus on actually, you know, the exploration piece and drilling. So the company can buy small specialist rental businesses on low margins, you know, on low multiples, typically sort of 4 to 6 times EBITDA, and then drop those assets into their global, framework for renting to big tier 1 customers. And so there's a nice kind of synergistic M&A story. They've got about 25 million of debt, but that gives them some firepower still to continue to do M&A. So it's an interesting, it's our only exposure to the oil and gas industry, and it's a picks and shovel play with a renewable energy exposure as well.
Yeah, I mean, it looks very sensible in that area, particularly as a lot of the oil and gas producers and explorers have got huge tax incentives given the windfall tax which was imposed by the government to put in new capex, so they don't have to pay this windfall tax, and that sends a huge ripple effect downstream to the picks and shovels plays. Now another one, Porvair, top quality sort of like filtration, ceramics type business, etc. Got big interest, I think, in India. Do you want to take us through this one? Because again, I think it's run by a guy built Ben Stokes or something. A super high quality business.
So it's probably I think it is our only industrials company in our portfolio. I think that's probably sort of telling the types of companies that we look for, trying to not invest in cyclical businesses. Yeah. And Porvair is exposed to sort of long-term, structural growth trends in terms of, environmental regulation, carbon efficient transport, manufacturing efficiencies and stuff like this. They are specialists in filtration and environmental technology, and they operate in these very, very niche markets where there are very long life cycles. So, for example, they do the filtration systems on the undercarriage of aircraft, and commercial planes. And once you're designed into that, you're probably not going to be designed out for a very long time, possibly 20, 30 years. So very long life cycles, and consequently it has very high repeat revenues. 80% of their revenues are repeatable in any given year. So very high annuity revenue streams. Long-term track record is fantastic. 15-year earnings CAGR of 12%. That's because they're exposed to growth parts of the market, and they also have done some very sensible bolt-on acquisitions over the years. It's a high quality industrial. Profit margins, PBT margins consistently 10%. More recently they had, through COVID, the aviation market obviously, sort of dipped. You're now seeing the aviation market ramp up. They reported 15% growth in the aviation market in the first half. And actually that division is well set now because there's a number of new aircraft platforms coming to market, which they're being designed in on. So the aviation piece is very well set. On the sort of laboratory filtration side, there's been some destocking that's been going on. So that actually went, negative like-for-likes in the first half, I think about 5%. So kind of mixed trading, but on balance in line. And 20 million net cash, exposed to steady growing structural trends effectively around environmental waste and technology. So I'm very well run. Management team have been in place for I think 15 years.
Yeah, no, it's best in class business. I mean, another one which is in the software sector is Accesso, which does sort of ticketing and queuing technology for theme parks. And this one's been an incredible journey for investors over the last 20 years. I think it sort of like
a yo-yo.
Yeah, exactly. It started off at about 3p, I think, in about 2000, well, just after the .com, and then roared to sort of like 20 quid. Came down with a thud, obviously, during the pandemic when all the theme parks were closed. And has then come roaring back up, and it's at about £7-8, I think now. It's run by this sort of like a really entrepreneur type guy, Steve Brown, I think it is.
Yeah.
And, do you want to take us through this one? Because again, pretty unique technology, I guess.
Yeah. So I mean, Accesso's got a very checkered history. It's always been a good business. They've got a leading position in the sort of providing software solutions.
Yeah, it's Alton Towers, isn't it? Six Flags,
yeah,
Cedar
Six
Fair.
Flags, Merlin Entertainment. So they do things like online ticketing capabilities, virtual queuing. They've got retail point of service solution for, call it the leisure market, theme parks, ski resorts. They've got about 1,000 venues that use their software. But historically, they sort of became a cropper by buying some bad businesses. They got a bit M&A sort of hungry and very aggressive accounting policies. So they were capitalizing a lot of cost, and they were hiring more and more people in their R&D team that possibly weren't doing a huge amount. So eventually, I think in 2018, 2019, having been a kind of really strong performer, the wheels came off, and there was big write-downs on the balance sheet, new change of management team. Steve Brown came back to the business, having not run it for a number of years. And really, it's been a turnaround from there. And we think they have made excellent progress. They've reclassified accounting policies, they've reduced headcount, they've driven product innovation to drive organic sales. And of course, then COVID hit and everything shut down. So a lot of their customers weren't even in operation. But the consequence of COVID was that loads more types of venues need digital ticketing, queuing capability. So the ski resort market in America was a market that was quite reluctant to embrace any of this technology, but now is kind of absolutely embracing it, because they saw post-COVID that they needed to have technology and software helping kind of run their resorts. So organic growth has been strong, and as I said, the accounting policies are much cleaner now. So the company is on the front foot. They had about $65 million of net cash in the last quarter period. They've since done one medium and one small acquisition, and management are targeting $200 million in revenue in 2025, which we think is achievable, and a 20% cash EBITDA margin, which is really a pretty good proxy for free cash flow. I mean, after tax, there's not much technology spend that goes onto the balance sheet, so it's very clean accounting. And so I encourage people to look at it, particularly the cash flow forecast for the next couple of years. We think the shares will look attractively priced, and sort of been a bit of a yo-yo experience for investors. But we got involved sort of as it was coming out of the COVID lows, and we've got high conviction that this business has got further to go, and is run by the right management team. Yeah,
Steve Brown has really got his hungry, isn't he, to turn that one round and about. Now, just finally, then another category killer, Instem, which is sort of like drug discovery, project management software, and FDA filing software for the biotech areas. I'm guessing, again, it's a sort of like a picks and shovels play on healthcare innovation, but quite a few of the biopharma companies have been pulling back the horns as the cost of capital increased, and therefore has been shelving some of their R&D. So you've got a bit of a sort of like a mixed short-term type of outlook, I guess.
Yeah, Instem, as you say, is kind of a bit more of a pitch and shovel play on the drug development market. They're a sort of software and services company. They service 19 out of the top 20 pharma companies, and their solutions, software modules, are all designed to help bring drugs to market quicker through different functionality. So one of their modules, Submit, provides us a suite of tools to help drug companies put their FDA application into the right format before submission. So it's these types of things. They've got very strong market position, 20% plus in most of their categories that they operate in. So it's a leading business, small company, 150 million market cap or so, and it's got a strong track record of organic growth and some acquisitive growth. They've been switching to more of a kind of SaaS business model over the last couple of years. They're making good progress in that, and yeah, I mean, a lot of data passes through their software. You know, there's literally almost every drug that ends up at the FDA goes through Instem software at some point. So the amount of data they have access to is vast, and there is some exciting but early stage talk about possibly trying to monetize some of that data in a sort of analytical module that they can sell back to some of their clients
benchmarking type of information.
Yeah, exactly. Quite early stage. They've recently made a few announcements in relation to that, but fundamentally, you know, it's a really nice little business. You know, 15 million net cash, good margins, good cash generation, but it was highly priced. You know, it was up in the 30s PE, like a lot of sort of software companies were. And when interest rates went up, you know, valuations came down. So, you know, the share price come off a bit, but that's principally been around derating with interest rates going up. You know, we feel like they've got a great runway for organic growth and margin and you know, margin accretion over the next couple of years. And it wouldn't surprise us if at some point, you know, someone came along and bought them.
Yeah, no, would I. Okay, well, brilliant. Well, thanks, Josh, for all the insights. I mean, I would highlight to investors, have a good look at the Whitman Asset Management sort of portfolio, and you know, perhaps investing. I mean, I've never seen so many high quality stocks in one portfolio. I mean, all the EBIT margins are well over well over double digits. So yeah, you've certainly selected well. If people want to invest at all in the funds, Josh, how best to do it? Obviously, got to be careful with compliance, but of course, what should people do?
Yeah, so we've got two small cap strategies. We've got a small cap fund, which is called the TB Whitman UK Small Cap Growth Fund. It's on all the platforms, so people can buy it on platforms. It's coming up to its 3-year track record, and we're sitting, you know, I'd say we're doing fine. We'd like to be doing better, but we're doing fine, doing better than average. And we've also got an AIM IHT service for those investors that might want to look at some inheritance tax mitigation by investing in AIM stocks. So if people would like to do that, then they can get in touch with us via our website, send us an email or give us a call, and we can help.
Brilliant. Well, I say those were 17 super quality and high recurring revenue, profitable businesses. So thanks very much for that, Josh, and look forward to touching base in 6 months' time.
Yes, thanks for your time. Appreciate it.